Hi, today we're going to talk about old age security and the clawback of that on seniors' tax returns. OAS is a pension paid by the federal government to people who've lived in Canada for more than 40 years after achieving the age of 17. There's in fact a prorated smaller pension that is eligible to be paid to people who've lived as little as 10 years in this country after the age of 17. The current maximum is about $6,500. It is paid monthly and it is indexed quarterly according to the CPI index. The current age to begin this pension is age 65, though recent legislation has moved this to 67 and is being phased in for those born from 1958 to 1962. So anyone born after 1962, the first age to receive this pension will in fact be the age of 67. This pension is in fact taxable on your personal tax return. So how is old age security clawed back? This is based on the net income on the personal tax return of the senior and is done on a calendar basis. There is a threshold amount of net income on a personal tax return above which the OAS begins to be clawed back at a rate of 15 cents per dollar in excess of the threshold. So the current threshold is approximately $70,900. So for every dollar above that level, you will lose 15 cents of your old age security, and you will lose it all by the time you reach approximately $114,600. This amount is clawed back on a calendar basis, which begins in July and ends in June. So your 2012 tax return determines the OAS payments that you will begin to receive in July of 2013. Your 2013 tax return would affect the payment of your OAS security beginning in July of 2014, etc. So here's a numeric example of how OAS is clawed back as we have net income in excess of the threshold amount on an annual basis. It is important to understand that seniors, especially at the top, losing all of their OAS clawback, take this very seriously and feel the pain of this loss almost more severely than any other income tax bill. So having said that, let's look at ways that one can control this clawback. Recipients of old age security need to be aware of how certain types of income impact their personal tax return and make it more likely that they in fact will be clawed back on this old age security. An example of that would be investment income earned on your personal tax return that you are not actually spending. An example of that would be GIC or bond interest that's simply being reinvested and not spent in the current year that you're being allocated it. Another example would be eligible Canadian dividends, which for the purposes of the tax return are in fact grossed up by 38% and may well in fact make it more likely that you're being clawed back on this mythical amount, which all affects the way these dividends are being taxed, and something to keep in mind about pushing that above the threshold amount. Finally, we need to look at certain types of pension income, such as RIFs, that if you do not need the cash flow, you should maintain your RIF payments at their minimum to make it less likely that it will in fact affect your OAS clawback on an annual basis. So how can NexGen help with OAS clawback? If in fact you are receiving investment income that you do not need to spend, then NexGen's patent pending corporate class mutual fund structure will offer you the compound growth tax class, which is intended to defer all investment income not needed to be spent this year. If in fact you do need the cash flow, then we will offer you the return of capital class, which will give you cash flow by returning already taxed capital and deferring the growth, and will not show up on your personal tax return, and as a result will not affect OAS clawback. Hopefully that helped you understand OAS and its clawback, and please refer to our document on our website about this topic for further information.